that's being done.
Hello, everybody. I would prefer to use that one rather than say good morning or good evening or good day, because I don't know what time I'm watching this video, whether it's the morning time or afternoon or evening. So it's better to say hi or hello. My name is the Saubrey Boyz Walefatshe from TBR. The TBR is nothing else but the Big R Solutions. What is the Big R Solution? The Big R Solution is all those R words, but only those that are positive, like reading, research, relationship, responsibility, review, reflect, results, all those words. We say if you follow them, you'll be able to resolve your financial issues. Now, as part of the program or the process of learning in education, because our work is to educate about money, because I always tell people that the trick is there. Just understand how money works. If you don't understand that, you won't be able to make it. And the money has a lot of facets that you need to understand. And one of those key or the is the credit or debt. All right. So if you understand what debt is, then you are on your way to success. So now I've invited XDS. I've worked with XDS before. If you go to our YouTube site, you'll see that we have interviewed Anna Rita before, where we spoke about what is credit score and all those things. So that journey continues. As I've said, it's a relationship. So relationship has allowed us to continue to do all these kind of things to make things easy for you. Let me welcome Lerato, who's going to be the person that I'm going to interview today. Lerato Thwane. Am I right, Lerato Thwane? Thwane. There you are. I'm happy when you correct me. All right, Lerato, welcome to the show. I would like you to introduce yourself. But what I can say, Lerato is an esteemed person. Lerato has a master's degree in finance. Lerato has experience, 15 years experience. But I would love her to introduce herself so that I don't shortchange her or I don't undersell her. I must sell her. Lerato, just introduce yourself. Welcome to the show.
Thank you, sir. So I'm Lerato Thwane, as I have been introduced, and I work for Mettus. Mettus is the group that owns XDS. And at Mettus, I'm responsible for the e-commerce, which is where our digital platforms are based. And the digital platform that we work with in terms of financial wellness is called Splendid. So my background is pretty much finance. And as I've been introduced, and I have taken a lot of interest in personal finance since my current role is with regards to the wellness of individuals as far as the finances are concerned. So, and I think really you can look at the educational aspect, but you can also think about it being something that you also experience personally. So it's closer to my heart because it affects the individual, and I cannot take myself out of that and say I'm educating others, because I'm also learning as I grow with my own personal finances. So we've got a platform called Splendid that is directed at assisting people with their own financial wellness, which everyone who's listening to this video can always go in and grow themselves. So we really talk about how we are allow you to check your status to see where you are and to fix it if there's anything wrong, and then to grow and flourish from there.
Now, as I said to you, Lerato, that debt is a new money. Debt changed, I mean, the money changed in 1971 when President Nixon of America decided to change the dollar, separate the dollar from the gold, and then immediately after they had the relationship with Saudi Arabia, and then it was an agreement was reached that oil now will be sold using dollar, petrodollar. I'm sure you hear that concept so much these days, petrodollar. So that changed everything. So debt became a new money. So that is why it's very important to understand that. Now, this animal called credit score, because when people go and borrow, then you are being told that your credit score is so low you have been told you have been dishonest and all that. What is credit score and why is it important?
Okay, so credit score is a measure. So maybe if we just take one step back and start with credit and say, what is credit and why is important? So credit is really a means to facilitate your growth, because as you earn money, whether it's from your first job or whether you've been working, there's going to be instances where the money that you earn is not sufficient to cover what you need to do right now. And you want to do certain things that you maybe don't have the lump sum for them. So those are things that facilitate your growth, whether you're paying for education, yours or your children, or whether you're paying for buying a property, you're buying a car and all those things. It's not often that we have that money cash to be able to fund those things, and whether you have emergencies. So there needs to be a facility that is available for you to go and borrow money whenever you need to, and then you pay back. But the key to this is being able to pay that money back. So credit is that money that is available. Others, whether it's bank, other financial institutions, whether it's even other people that will lend you money, even from family and friends and all that. So that is basically what credit is being able to borrow that money. And I always emphasize that it's to facilitate your growth, because if we all look at it like that, then it takes away that point where we think that it's to facilitate our lifestyles and things that we need to do today and just enjoy, where we're not using it responsibly, and then we find ourselves in that situation. So when you borrow money, you obviously are promising and getting into a contract to say, I promise to return it. So even if you're borrowing money from your aunt, for example, you go to auntie and say, I would like you to lend me 20 rands and I'm going to return it on Friday. And on Friday, you need to then go to your auntie and give her money back. So if you don't give it to her on Friday, and then by next Tuesday, she's busy calling you and trying to find out where's the 20 rands, her trust in you reduces a little bit. So the credit score is the measure of your trust. So her measure of the trust in you, she'll know that, okay, I'm reducing, this person is not trustworthy and reliable. So banks and financial institutions do the same. They will lend you that money, you sign a contract, you say, on the 15th of every month, I'm going to pay 100 rand. And you need to pay it on the 15th of every month, the 100 rand. The minute you don't pay the 100 rand, they penalize you by them, it affects your score. So the credit score is really that measure of how are you able to fulfill those promises that you have made with regards to returning what you have borrowed. So you put it in numerical order, where the higher your score is, the more reliable you are, and then the lower your score, the more people are going to take caution before they borrow you. So it's used in the industry to look at before people lend you money, so that they know what are they dealing with. So can determine whether you get the money or not, or it can determine what kind of interest rates you get. Because if you are not as reliable, they will lend you, but your risk, because your risk is higher, then it will be lend you at higher interest rates versus someone who's very reliable, who can then be relied upon to return the money as and when they have promised to.
Let me simplify what you have just said. You have mentioned one of the beautiful R words, which is reliability. So in other words, the reliability part of it will lead to the trustworthiness. In other words, the more you are trusted, the better chances of you making more money. If you are not trusted, the chances are you are not going to make more money. You've also mentioned something very important, that if your reliability cannot be banked on, that also has an impact on the interest rate. By the way, the interest rate is the money that they charge you. Remember, they borrow you money, for instance, if it's for credit card, they borrow you money, and then their profit or their income is the interest. So the more unreliable you are, the more interest it becomes. That's what you are saying. Am I correct?
Correct.
Okay. Now, what are the factors included in the credit score? What are the factors that really makes this reliability and trustworthiness to mean something?
Of the utmost importance is the payment history. So that history of how have you been paying everyone that has lent you money. So that history then becomes almost your track record. So that is very important because every lender wants to look at your previous history to say, how has this person been performing? What has their track record been like? So they look at that. They look at the utilization of your credit. So when you apply for credit, you will be assessed according to your affordability to say, okay, your earnings are this much, your expenses are this much, therefore you can afford so much of debt. And when that amount has been applied, then it's available to you, but it does not mean that you need to use it all today. So it's basically available for you so that when you have those emergencies or when you need to do those things that are important in your growth, then you can be able to access that money. So the more you use and the more you get to the maximum of what is available to you, then other lenders start to have to have a caution when they think of borrowing you, because they're thinking that maybe you're getting a little bit distressed, so they mustn't give you more than you can actually afford to pay. So that the utilization then also plays a role in assessing the score. And then the length of your credit history. So the longer you've been on the lending market where you've been borrowing money and people have been lending and you've been repaying it, the longer you have obviously the history that shows your reliability, if you are reliable, and if you're not, obviously it works against you. So that is also determining that the length of your credit history. So when you're new to credit, you find that you start off with a lower credit score, which is not a bad thing because you have never borrowed before. So you earn that trust basically by how you behave once you get that credit, and then your score starts to improve and increase.
Two things that I want to pick up. Two things that I want, sorry to cut you short there. One, you said the credit utilization, very important. You say what you want to say, but I'm going to mention this too so that you don't forget that. And the other thing that you have just mentioned, new credit inquiries. So in other words, if you don't have debt and you start now, your score is low. That's what you are saying. Credit utilization, for instance, you have somebody awufikile lapha enesipotini laphana uye bezwa ngaye gcwalisa itafule lapha hayi credit card ikhona faka imali uzobona. And then so that's a bad usage of the money. So in other words, financial institution, they won't take that person serious because he doesn't understand how to use his money. Am I correct?
Correct.
Okay, so yeah, go ahead. You wanted to finish something. I decided to interject because I wanted to clarify those 2 points.
Sure. So linked to what you're saying, it's the credit mix. What type of credit are you taking? Just as you're saying, if it's just credit cards that you're using for consumption, versus if you're using credit to buy property, which is looked at as an investment, or things like a car, which is looked at as something that facilitates obviously your growth because it leads you to be able to have transport to do what you need to do to earn a living. So things like those which are assets, or you're finding education and those kind of things are regarded as better credit. So when you're taking credit for those types, it's looked at as positive. So that is a good thing. And then how many credit inquiries are you getting? So credit inquiries is when you are busy looking for credit and then you're applying at various places. So once you start to be applying every day or it becomes worrisome to say, this person is busy trying to borrow from different entities. So if I give them their money, what if they are already getting it elsewhere? And then they become distressed and they're unable to pay. So you also need to be careful to not do too many credit inquiries at the same time. So when you're applying, maybe apply, wait for a response, and then apply elsewhere. Don't just try and apply it in too many places at once.
Okay. That's a new one because we learn every day. You are saying the more you go up, because remember, if I go to Edgar's for that matter, I do a clothing credit, they are going to make an inquiry to the bureau. Yeah. And then I go to another shop again, they are going to make an inquiry. The more I do that, that affects the level of score in terms of The more you do, the lower score you'll accumulate. That's one. Am I correct?
Yes.
Secondly, you said, let's say, argument's sake, you are the person, yours is to borrow just for consumption, credit card, consumption, clothing store, sometimes even food, food, and then, so now you as credit bureaus, because it gives an impression that this man is borrowing money just for consumption. So he's not an investment man. That also has a negative impact on the individual. Am I understanding you correctly?
Yes.
Okay. Compared to somebody who borrows money, buy property, and then maybe do it as a rental property and move on, borrow money for business facility to build a business. So that one is seen more positively as compared to consumption, as compared. Am I correct?
Yes. Yeah.
All right. Now, why is this so important for anybody to always check the credit score? Because sometimes we don't check the credit score and monitor how healthy our credit score is. No fraudulent activities that has taken place. We know the identity fraudulent that is circulating around. Why is it important for always to check?
It's just similar to your physical health check that you never know what's wrong with you unless you do this regular test. So even there, you just go and have a look and see, what do I look like? Because you may find surprises. Or sometimes you had your behavior and you're thinking that it's in check, but maybe a lender has forgotten to close your account, which you think you have closed. So you can be able to go and link up with them and rectify that. It's just to basically look and see that, is the record that is being shown on my name still representative of my own actions and what I have personally done. So check your score. Does your score still look like what your score should be? Do all your accounts that are listed there, do they belong to you, or are there accounts that you don't know about? The accounts that you've paid up, have they been closed and showing it's paid up? So it's just to make sure that there's an alignment on yourself, between yourself and what is on record about you, right? Because that is the information that is going to be used in future should you require credit. One. Two, to just also monitor how healthy you are. So the credit score will give you a determination to say, okay, do I have a good credit score still? It's become low. What did I do? And how can I correct that? Number three, it's also just to spot those potential fraudulent activities that could have happened with your ID. Maybe you lost your driver's license and somebody went and opened an account in your name and you don't even know about it. So when you go in there, then you say, oh my goodness, that's not mine. And you are able to then go and rectify that. But also, which is why these digital platforms are just so pleasant for that purpose. Because, for example, on Splendy, if you are registered on Splendy and you can go in and check your credit score as many times as you want, we don't even charge you for it. You can just go in 10 times a day, every day, whenever you want to. And once you are registered, they will also do the monitoring for you, so that if an account is opened in your name, then we are able to inform you and let you know, and you are able to respond to that. But I mean, primarily, you need to just go in and check. Go in and check yourself. It's very important.
Now, you bring me to something very important. You said check whether there is an account that is paid up. Now, let's say account is paid up. Is it wise to close that account? I'll tell you why. You don't close the account. The next thing, there is an insurance on that account. It keeps on charging, all right? I know that I've closed this account, but I say, hey, you're owing 300 rand. It may look small, but guess what? It will rise, okay? Now, is it wise if let's have paid up Woolworths? Should I close it and say close Woolworths? And then maybe next time when I want to use it and say, okay, guys, can you reopen Truworths again? What is the advantage of closing and not closing? Because as I said, what is the point of having an account? Maybe it's a clothing account, and then you have paid it off, But now, because you didn't close it, then the service fee continues. Not only the service fee, the insurance, so on, they still continue. And then, which is not good for you because it makes you to spend the money that you don't have. Even if you have, that's just a hole that leak. It's a leakage which should not be allowed. So what can you say about it? Which one is much better?
It's correct. So I think it's a question of why you open that account in the first place, right? So when you open that account, once the purpose of it has been fulfilled. So if you opened it, maybe say it's a clothing account that you opened because you wanted to get uniform and all that, and then you think, okay, I've fulfilled its purpose, I've paid it, it's paid up, and I don't think I will be needing it anymore. So if you feel you won't be needing it anymore, the best thing is to close it. But if you feel that you're still going to maybe next quarter need to top up the school clothes or the clothes that you need for either yourself or your children, then obviously keep that one open. So disadvantages and advantages. And the advantage of keeping it open obviously would be the fact that you can always access that credit without going to reapply when you need it. And in the future, if you believe that you're going to need it. But so that's your advantage. The disadvantage being that if there's any admin fees on it, and if there are, like you're saying, some of the accounts have loyalty programs that are paid for. So those little amounts that you pay for loyalty programs. So just check on that and make sure that you understand those. And if you keeping it open, you know that you still need to pay that nominal fee at the end of each month. But if you have done what you needed to do, it has fulfilled its purpose, it's best to close it, because when you close it, then you don't have to incur any further expenses for an account that you don't actually need at the time.
Now, let me find out. Now, I've decided to close, let's say there are about 5 credit agreements, I keep one. So will that not work against me in the future that you open and then close, open and close? Will that not work in terms of the score?
So remember when we were talking about the factors that affect your credit score, we said the length of your credit history. Yeah. So it becomes important to keep your history continuing, you know, so don't break your payment history, so that when people go and inquire on your name, they can see that you have been reliable for a period that is that long. So I mean, we're not talking leaving all your 5 accounts if you have 5 accounts open, but if you can have one that has got a longer history that is continuous, then it allows that history to be visible to other lenders to see that you are reliable and you can pay. So as much as we're not encouraging you to have a lot of accounts, but it becomes important to at least keep one that is continuous, that is going to allow your history to flow. Otherwise, when you close, then for the period that you have been closed, then you don't have that activity that allows lenders to assess whether or not you are still good for credit.
I always say, when it comes to finance, there are no yes or no answers. It all depends for what purpose. So ideally, it would be wise to say, close all of them, you don't use them, keep only one, so that for the purpose of what you call continuity and the history, the length of the credit, then at least it helps. So we can agree to that, isn't it?
Yes.
Okay. Now, I want you also to speak about Splendy, because you are always talking about Splendy and its role in the credit industry or credit education. If you can give me more information as far as that is concerned.
Yeah, so we simplify Splendy's role in 3 words. So we're saying check, fix, and flourish. So first of all, check where you stand. Where do I stand? What's my credit score? What accounts are listed? Do I agree with everything? If when you check, there's things that you don't agree with. So for example, if you find that there are accounts that you don't know about, then you can dispute them on Splendy. So we allow you to dispute. So you're now getting into fixing that. If your credit score is low because you have had a certain behavior of non-payment, then you get to know about it. Then you're thinking that, okay, next year I maybe want to buy a car, I want to buy a house. Let me get my credit score to grow again. So you do the right thing. So we'll advise you in terms of, okay, this is what you need to do, and this is how you could pay your account so that you can grow your credit score again. So that's part of fixing your circumstances. And then you can also, if there's an account that you have closed, but the service provider hadn't closed it, then you can then dispute that on Splendid as well, and then we'll assist you so that it gets closed and your record shows as of what you know. So you've checked it, you've fixed it, but most importantly, we want you to thrive. So that's where you're saying flourish. So for you to flourish, we give you a lot of credit education. We give you a lot of financial education. We give you a lot of advice, but not financial advice. We basically give you information that is going to assist you to do the right things, to tell you, okay, now we've got interest rates going down. What does it mean and how does it affect you? But do understand that when it goes back up, you still have those monies, all those things. So there's a lot of information on financial wellness, on financial decision that we just put there for you to consume. So that's our credit education. So that's helping you to grow, and that's helping you to make better decisions in the future, so that if you were in bed standing at some point, you can then be on the lookout for the do's and the don'ts, so that you maintain a good credit score or a good financial standing. And if you are good, you know why you are good and you know how you can even get better. So that's basically what's with.
Okay. Now, having said what you have said, I'm a debt counselor. That's one of the things that I do. We know that once you are under debt review, you can't be able to open up another credit. I've seen it in my industry because I want you to explain what's happening here, whereby I have a client who pays very well, and then he finish almost all the debts. According to our industry, if you have finished everything except the house, and then you are up to date with the house, we can clear you. But I've seen it whereby a person was not even cleared, and then the person goes and borrow to the creditor lend him. I saw one where he was lended about 5 million. And then the client then said, I went there and then I borrowed money. So what is happening there, if you can explain?
Well, I mean, that would be, so the lender would have obviously lend that person without analyzing their risk, because when you are on debt review, at the credit bureaus, your score is put at 0. So that 0 represents the fact that you are still in the mending process. So as you're in the mending process, we don't want to further bombard you with more credit. So it becomes 0 as an indicator to all the lenders that you are not at a state where you should be getting more credit, because we are just trying to correct your current circumstances so that then you are able to be to repair your credit health, and then you are able to lend again if you need to, right? So that's what it is. So when lenders then go and borrow somebody money, when they see that they're on debt review and they've got a credit score of 0, it becomes very questionable, because then it means, how are they assessing the risk? What are they relying on to assess their risk? And they can't hold anybody accountable. So I guess it's their own risk appetite. So I wouldn't be able to answer really on how they made that decision.
Will I be correct to say the credit industry has a lot of stakeholders, and all the stakeholders are independent, and all other stakeholders are in an advisory capacity, helping in other ways? For instance, you as credit bureau, your job is to advise, to say, know very well, if you borrow Saubrey money, this is the situation. Now, whatever decision that they take as a creditor, it is their independent decision. Even if after they've made their own needs analysis, but they are aware that this is the situation, but they go ahead. So in other words, I'm trying to say nothing stops them to lend the money. They can do it, but that is at their own risk, all right? Because in future, if things goes bad, they cannot blame anyone because they had all the indicators. Your credit bureau said the score is 0. But you, as a creditor, you know that no, this man has finished almost all the debt. Is left to 1 or 2 or 3, and then although he has not yet received a what you call a clearance certificate, but I can issue him another debt. 500,000 is a huge, and it was not only one; it's more than one. So that is at their own risk. Am I correct?
Yes, it's a discussion of learning.
Okay. Now we'll continue with this discussion, and then I just want to make the viewers aware there that we'll have part 2, because part 2 is important of this. So I'm gonna allow you to say something about what are the tips that you can give people in order to improve their credit score. What should they do to improve their credit score?
Okay, so it's basically the inverse of what we're talking about what affects it. So, for example, pay your bills on time. If you said you're going to pay 50 rands every month on the 31st of the month, pay the 50 rands at the 31st of the month. Don't pay on the 7th because they look at when you had promised to pay. So pay on time, pay the correct amount. Keep your credit card and those consumable balances low. Don't go and max them. Avoid closing all accounts to the extent that it affects your history, that your history of payment breaks. So you need to have at least a continuity as far as your payment profile. And you must limit applications for new applications. So don't go like I had indicated before, don't go and apply in too many places at once when you are only looking for one thing. Apply, wait for the response to come, and then assess that. And if it's suitable for you, take that, or go and apply elsewhere. But don't limit the amount of applications that you make at any given point. And really, the key is to only take as much credit as you can afford to pay. Right, which is something that we don't talk about, because sometimes you get access because people, they'll look at your income and they will say, okay, we can give you this much, but you know your other expenses. For example, expenses that are not documented anyway. Maybe you send money to your grandmother every month, and you do this and that and that and that. So you know what you can afford, because those are not taken into account when that affordability analysis is done. So only borrow really as much as you can afford to pay, and you can afford to still be comfortable to continue to live your life.
You know, having said what you have said, I had one client who came here, and then he wanted to be cleared. He had finished everything. We cleared that client. He was cleared. Then he went to a creditor. He was applying. Remember, NCR will say 21 working days, okay? Because there are many credit bureaus, so they have their own standard, how long it takes to clear you, all right? So that is why they give 21 working days. So now a guy goes, we tell them that it's 21 working days, but sometimes they try their luck, maybe because they're under pressure. They try and borrow, and then an inquiry is being done. So I've seen a situation whereby a person goes within that month again and make another inquiry. And then the client said, I said, no, we've cleared you. We've sent the clearance. Then when I asked, the creditor was saying, no. He made an inquiry, and once you made an inquiry, you must wait for 3 months. When he makes another inquiry, it's another 3 months again. Am I correct? Was that correct? Was that correct? No, they say once he has made an inquiry, okay, then that pushes him to make another inquiry after 3 months. He attempted to open up an account. Then it failed, okay? Then within that month, he attempted for the second month. They said he should have waited for 3 months for that one to lapse, the first one, the first attempt. And then when he does, it adds another 3 months. Am I correct? That's what they were saying. when I was asking.
I guess it depends from credit bureau to credit bureau then to about that. So I cannot answer it categorically that you need to wait 3 months, because you could find that you apply for this type of credit and then maybe within that time, so you've just got your car and then you go and apply, and maybe you're looking for insurance for that car, because some insurance.
Sorry about that. Our time is up. Let's move on. We'll move to the next the part 2. Thank you so much for your time, Lerato, and then we'll go on with part 2 so that we move on. Thanks. That information is very valuable. It will help. Much appreciated.